Hello. So today's chapter is structure is memory. Let me pull that up real quickly. Oopsie, wrong one. One second. Oopsie, here. One. That's the one. Okay. Here, perfect. Should be all good. So structure is memory. The market remembers where imbalances occurred and it returns to resolve these. These sometimes create FEGs and other great things in those kind of ways. And it's just laying or resting orders from the past that it wants to sometimes refine the nose or the liquidity pockets that it's searching for from prior orders, depending if these orders still exist. They will either slowly move into that direction and actually be taken out, or they will just yeah, slowly revere back if there is actually no orders that then come in during those times of the market. Price price leaves evidence behind. Markets do not forget unfinished business. Structures forms from repeated decisions. Memory exists through highs and lows. Understanding structures reveals intent, and this chapter teaches how markets remember. So, why is this chapter important? Many traders misidentify structures like breakup structures and change of structures can sometimes be very similar. So that's why there are some good indicators out there that can help you identify those at the beginning. And many people love trading those like an order block compared to a breaker block. And structure provides directional context. Entries without structure lack edge. Memory explains why levels matter. Structure filters bad trades. Precision increases with structure. And this chapter anchors bias. What is market structure? Structure is a sequence of highs and lows. Structure reflects market decisions. Every swing represents acceptance or rejection. Structure forms from participation. Structure shows who is in control. Trends and ranges are structural outcomes. Structure is context, not predictions. Swing highs and swing lows. Swing highs mark sellers' control. Swing lows mark buyers' control. Higher highs show strength. Lower lows show weakness. Equal highs and lows show balance. Swings reveal intent over time. Memory is built through repetition. Learning certain patterns over time and spending a lot of time in the market can teach you a lot of those things. And sometimes there's failed auctions in a higher high, higher low kind of pattern. And those are kind of those things that reoccur over and over and over and over again. So that's why it's good to realize that it's market based on probability. It's not math. It's not perfect, and a lot of patterns reoccur. In my personal belief, I like patterns and other things in those ways because sometimes when there's enough volume coming in and it's very similar, it's the exact same structure as the last time around. It could go the exact opposite way, but that's kind of how we find very good systems to trade. And that can be the system that you trade on a daily or monthly or weekly. Trend structures. Uptrends from higher highs and higher lows, downtrends from lower highs and lower lows. Trends reflect sustained dominance. Pullbacks are part of structure. Trend strength depends on follow through. Structure defines bias, and fighting structure increases risk. So these are also very, very important things because let's say that there's a support level, like right approximately here, nice little support level, and it hasn't been breached. But actually, this could have been the level first. So, like right there, and once it breaches through, sometimes it hammers against it, and then it makes a resistance level into support. This is why right here we see that it has a little bit of problems first going through there before then it accepts it and bing, all the way down. Highs and lows are repeatedly defended. Balance creates memory, and liquidity builds at range extremes. Breaks require participation, false breaks are common, and patience is always required. Break of structure, something I mentioned beforehand. It's a break confirms directional intent. Break of structure signals control shift. Structure must be clearly defined. Weak breaks lack follow through. Strong breaks occur with participation. Time confirms validity, and break of structure is context, not an entry. Because the pattern that broke from doesn't mean that now all of a sudden it has to keep going downwards or upwards depending on how you position yourself beforehand. It just means that now there's a somewhat of a shift or some kind of change is happening. So you kind of need to play with the changes or breaks of structures to kind of just understand the market, and that's the biggest thing. It's more about understanding the market to then take the correct trades over time. Chart signals early shift in behavior. Momentum begins to weaken. Buyers or sellers lose control. Structures start to realign. Chart CHOCH precedes reversals or range. Context defines outcomes. Confirmation is required. Structure and liquidity. Structure forms where liquidity exists. Highs and lows attract orders. Breaks target liquidity. Pullback reveals unfiltered orders. Structure aligns with liquidity. Structure without liquidity lacks power. Precision comes from alignment. Structure and time. Structure strengthens with time. Breaks during high participation matters more. Low volume breaks often fail. Time validates structure. Session context adds reliability. Timing filters false signals. And structure is dynamic. That's why higher time frames are sometimes better for this kind of stuff, because you can slowly veer in from, let's say, a hourly time frame down to like a minutely time frame. If you're at an hourly time frame, you then can see that slowly we are getting somewhat of a move that is like a break of structure, and then you can see in a 1 minute to 5 minute to 15 minute how long this move will take until it's actually like a very solid move that goes like a reversal, or if it's a continuation over time. So that's why you can zoom in and zoom out over time, and that is one of the best things to do. Common structure errors. Forcing structure onto noise, ignoring higher time frame context, mislabeling minor swings, trading every break, confusing volatility structure, lack of patience, overconfidence. All things that can make your trading very self-sabotaging with the growth of ego, because sometimes too trading can be like gambling, but that's one of those things where actually in gambling your mind is um, more inclined to lose. So if you have a really good trading day, at some point you almost want that feeling or that chemical release of losing a really big trade, because that's like the better release, and that's why gamblers most of the times fail. They don't realize what is going on. So that's why you gotta kind of understand the psychology of trading. Structure defines environment, bias is determined before execution, entries are secondary, risk is planned around structure, institutions wait for confirmation, memory guides decision making, discipline creates consistency. Structure in practice. Identify higher time frame structure, define key highs and lows, observe breaks and reactions, wait for confirmation, align with liquidity and time, execute with precision, and manage risk objectively. Structure across markets. Structure applies to all instruments. Future, forex, and crypto follow structure. Timeframes do not change logic. Market mechanics are universal. Context scales, just like I was explaining with the timeframes beforehand. Precision improves with experience, and structure remains constant. That's why it's one of those things where break of structure or change of structure is very important to learn over time. And like, there's so many things to the trading markets, but if you find a system you personally like break of structures or breaker blocks or just liquidity and understanding volume with scalping or whatever kind of trader you are, with reversal trading and all those kind of things. They all can help out by just learning more to the one game that you want to play. Structure is market memory, highs and lows matter, trends and ranges are outcomes, balls and charts provide context, structure guide bias, liquidity and time confirm structure, patience proves precision. And that is this chapter. Good old structure is memory. So over time, you can really realize how much of a memory game trading truly is. History rhymes and history repeats. And that is all to this chapter. I'm not exactly certain what the next chapter is, but that will be chapter 6. And yeah, you guys have a wonderful day. God bless. Mm-mm, 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 mm-mm.